To Vincent Juvens, global market strategist at JP Morgan Asset Management, who joins us this morning. Vincent, very nice to speak to you. In fact, we've seen a very strong run for European stocks. I wonder how much further to run you think they have. We saw 7 days in a row of new closing highs for European stocks. That is something we haven't seen since 1999. The percentage is very different. The percentage back then was much higher in terms of gains than it is now. But certainly the number of days in a row is quite similar. So do you think that makes sense? Are we right to be seeing such strength in European stocks right now?
Yes, I do. And you alluded to a couple of themes which are important in your introduction: Airbus, cyclicals, trade recovery, easing of trade tension, all elements which are obviously very supportive for European stock as a whole. So clearly we remain optimistic on European stock at JP Morgan Asset Management. When you look at the positioning of our multi-asset portfolio, we remain long European equities. This said, being positive on equity market, being positive on European equity market doesn't mean that we expect on top of the 10-15% already recorded here to date in terms of performance, that market will reproduce, let's say, the same level of performance in the months to come. So we need maybe to lower a bit or return expectation going forward, given the valuation we have already seen. You alluded to, obviously, to the comment of Jamie Dimon about trading revenues. We're probably going to see on market plateauing at some point globally, including in Europe. But Europe obviously will benefit from additional support in the coming weeks and months. Vaccination campaign are really speeding up in Europe. Europe is reopening. So on top of foreign and external demand, you will see obviously a very strong momentum locally, which will support earnings and economic activity.
And Vincent, how much is the low yield environment helping us to achieve that strength in European stocks then? You say it has a little bit further to run. Does it depend on what happens with the US 10-year yield, currently at 1.48%? Does it depend on what happens with bond yields, which the ECB seems keen to keep under control?
So clearly the interest rate environment has supported Europe. We have seen this rotation from growth into value, from let's say into cyclicals, and Europe has benefited from it. Clearly, European banking sector has been one of the main driver of the recovery of equity market in Europe. And we expect indeed interest rate in the US to continue to grind higher. I guess everyone is looking at the 2% level by year end. There should be some contagion in Europe, but we've heard from the ECB that they're definitely not in a rush to stop their easing program, stop their quantitative easing. So I would expect interest rate in Europe to remain well anchored. But indeed, it has been supportive for European cyclicals. For European investor, the fact that ECB is not moving means a lot. You may not be aware of it, but in Europe, for many banks are now obliged to apply negative rates on the household deposit, something we haven't seen over the last couple of years. So the negative interest rate becomes a reality for more and more savers and investors here on the continent, forcing them to look at alternative on financial market. Clearly, fixed income at the moment, given the upward pressure on rate, is not a real option. So you still see a lot of appetite for equity market in Europe. So this re-risking of European household is also one of the elements which supports European equities at the moment.
That's really interesting, that re-risking then of European households, pushing people into equities. I know there had been some debate previously about whether negative rates does that or whether it makes them save more. So that's an interesting perspective. Let me get your thoughts on the inflation story and the supply side of the inflation story that seems to be under stress, under disruption in many parts of the world. How long do you think before we start to see some normalization of these supply side difficulties that have pushed up PPI prices in various parts of the world? I ask this because I think that the rationale is supposed to be that as more people in the West get vaccinated, they spend, or they go back to spending more on services and don't spend quite so much on stuff, and therefore we get some kind of respite on the supply disruption side of things. Is that what you're expecting to see? What kind of time horizon, Vincent?
Yeah, at JP Morgan Asset Management, we expect exactly the same. So the inflation surge that we have seen recently, we consider it as transitory. We do expect that as of start of next year, maybe at the end of the first quarter, next quarter, things should normalize. Obviously, discussing supply side constraint, it's a vast topic because it goes from stuff as you describe it to semiconductor, and obviously each area has its own specificities. But indeed, I would expect European consumer, like Americans, like Chinese consumer, to shift from goods to services going forward, which should ease tension on supply side constraint that we have seen. In addition, I would say logistical routes are obviously improving again. We have seen that a tentative sign of, let's say, improvement in terms of indeed export from China, freight costs and so on, which are going down here and there. So I'm not too concerned about it. In the short term, it is clear it is an investment theme, and we need to go along with it. This means that from our standpoint, being short duration, long, let's say, assets which are well protected against inflation and stock stands out in this context. Over the mid and long term, we are not overly concerned about inflation. And somehow China maybe give us an idea of what to expect going forward. It's true that PPI remain elevated in China, but CPI is well contained. That's something we may see in a developed market as well. I have maybe a bit more question in the US, which is turbocharged with fiscal stimulus at the moment. In Europe, the story is a bit different. So to cut a long story short, we are not overly concerned about inflation, but the investor should rather indeed take, let's say, good hedge in the short term, and stocks stands out in this respect.
Vincent, thank you very much. Yeah, drawing our attention there to the lack of the link between the PPI and CPI numbers then in China. Thanks very much, Vincent Juvens from JP Morgan Asset Management. Stay with us, Vincent. We'll be back to you shortly. Coming up on this program, slipping from record highs, European renewable stocks have fallen around 27% since January. We discussed the move away from growth and defensive equities and talk about emissions trading schemes across Europe and what they can deliver. That's next. This is Bloomberg. Welcome back to the European Market Open. 11 minutes into Tuesday's cash equity session for Europe, and European stocks making moves to the upside. The CAC 40 lifted out of the gates by the Airbus share price, which has moved up by just over 1%. The Deutsche DAX doing well, though, up by 0.7% this morning. Let's take a look at what is on the move this morning. Some of the stock movers for you. Here's Danny Berger.
And consistently one of the most volatile stocks in the Stock 600 is CD Projekt. They're the maker of the video game Cyberpunk. It was removed from the Sony PlayStation Store because it had so many glitches. Well, it's now been put on what's called the wish list on the Sony Store, so people can kind of say that they want to buy it, which signals that it will be coming back to the Sony PlayStation Store, and that, of course, is sending shares higher. IAG also on the move higher this morning. The EU looks like it's set to lift travel restrictions for U.S. residents, so some of the long-haul carriers benefiting from this. Of course, IAG has a lot of ground to make up. It fell 4% just yesterday with those COVID restrictions being extended in the UK. Finally, Anglo American also under pressure this morning with a lot of the other mining stocks, given that we're seeing metals fall. Copper, for example, falling to a 3-month low. So with that being said, let's look at the macro picture. Copper, again, receding so far this morning. It had a rough day yesterday as well, with some of those inflationary bets backing off, that gas pedal being stepped off of, China demand also falling. But it's not just the metals, it's also the equity indexes. Yesterday, a pretty severe rotation into growth stocks. The Russell 2000 had fallen yesterday. So far this morning, futures are higher, but it still is tech that looks like it's set to outperform. Really one of the first instances so far this year where we are seeing people move back into growth stocks. So is this going to be back into that rotation away from cyclicals, or is this just a little bit of a correction ahead of the FOMC meeting, Anna?
Yeah, thanks very much. Yeah, copper prices to the downside. Basic Resources once again under a little bit of pressure, down 0.4% on that sector, and that hurts London, of course. Danny, thanks very much. Danny Berger with us. But I should say, of course, the balance of moves across these various sectors is to the upside. Chemicals, the biggest gaining sector this morning. Let's turn to renewable energy, and the European index is down 27% from a record high in January and is trailing the broader market and oil stocks. That's as rising bond yields and inflation have pushed investors to switch preferences to cyclical and value stocks and away from growth and defensive equities. Let's talk to Vincent Juvens, global market strategist at JP Morgan Asset Management. Tell us how you place renewable energy stocks then, Vincent, within all of those various categories, because it sounds like growth, but it's not technology. There's something much more secular going on when it comes to this sector. So I wonder how it fits in with that move into cyclicals. Tell us how you would position around renewable stocks.
There's definitely a secular story, and admittedly last year prices of renewable across Europe went probably too high at some point, which explained why obviously they're a bit under pressure this year. But clearly the secular story remains intact in our view. It's a broader theme, climate change, than only renewable we would like to mention. But obviously we have the US back, let's say, supporting global climate engagement. We have the COP26 at the end of the year, which is likely to lead to a grand climate accord, and countries around the globe are committing to net zero target by 2050. This means that the share of renewable in our economy will have to move up from less than 20% today to 80–90% by 2050. So this is really a structural support for this sector, which is clearly part of the solution. This said, when we look at climate change as a whole, as an investment theme, renewable are one of the items, but it doesn't mean that the traditional energy sector, that utilities don't have a role to play either. We just see that indeed the whole sector is adjusting itself to this new reality, as actually the firepower also to invest in this transition. So that's also one of the key elements we are looking at. More broadly, climate change and policies to address climate change mean that we will see higher carbon price globally. I discussed inflation a couple of minutes ago. We've defended the idea that we see it as a transitory phenomenon. There's something which is structural within inflation. It's the higher carbon price. It's not going to go away. What we are seeing in Europe, record carbon price since the beginning of the year, due to let's say, the extension of our emission trading system, is something we are likely to see globally, because Europe will force let's say, its position during the COP26, so we'll at least try to convince its partner globally that carbon price needs to be revised up. either directly or indirectly. Europe has a legal tool to force its commercial partner to really adjust their carbon price, which is a carbon border adjustment mechanism. So our expectation is for a higher carbon price, renewable or a solution, but across the board, we are looking at reduce the carbon footprint of our portfolio.
Let me just ask you about something else, just breaking across the Bloomberg, Vincent. Very interesting, your thoughts on the emissions trading system and how it's being copied in various parts of the world. Let me ask you, though, about trade deals, because we've just had confirmation from the Australian government that the UK and Australia have reached a free trade deal, so confirming the Australian government spokesperson confirming a free trade agreement with the UK. We'll wait to hear from the UK side on this, but we know that the UK and Australian Prime Ministers had a dinner over which this was discussed last night. I wonder how much significance these kind of trade deals can play. Clearly, there's a lot of focus on the UK trying to redefine itself on the global stage post-Brexit. But the Australian deal, we understand, is expected to boost the size of the UK economy by 0.02% over 15 years. This is not huge, is it? But is it all about symbolism, Vincent?
Yes, at least versus a year ago where we were discussing Brexit, trade tension between China and the US, we are again discussing about a more multilateral approach between Europe and the US, between the UK and several key partners. And it's indeed important for the UK to re-establish this trade deal that it is losing at the moment due to the Brexit. So all in all, obviously, this is a positive development for both economies, although obviously it won't, let's say, compensate for the loss which is driven by Brexit, nor for the UK, nor for Europe. So it is obviously a positive development. It's not the only positive development that we are seeing on a trade basis. So clearly, the improving trade situation that we're seeing globally is one of the elements which make us positive for the coming month in terms of economic expectation and in terms of positioning in our portfolio.
Yeah, really interesting to put it in the global context there of reduced trade tensions then, Vincent, and we look to the EU-US summit to see if we get any further news flow on that front, either very broadly or specifically around Airbus-Boeing, which looks as if there is a deal that can be done there. Now, Vincent Juvens, thank you very much for joining us. Good to speak to you. Vincent Juvens, Global Market Strategist at JP Morgan Asset Management, spending the last 20 or so minutes with us here on the European Market Open. Let's get a Bloomberg Business Flash, the top corporate stories we're covering here at Bloomberg TV. Here's Simone Foxman.
Thanks, Anna. Emirates Group slumped to a record $6 billion loss in the financial year to March as the pandemic upended travel. The state-owned airline received a capital injection of $3.1 billion from its owner, the government of Dubai, as a result. Emirates has been hit especially hard with the pandemic-related border closures. JP Morgan's expecting a 38% trading revenue decline compared to a year ago, more than it previously expected. It's a sign the pandemic-era trading boom could be drawing to a close. At a virtual conference, CEO Jamie Dimon said revenue would now be just above $6 billion.
Last quarter is exceptional. This quarter is what I call more normal, where you can plug in your model and make it really simple. It's like something a little bit north of $6 billion, which is still pretty good, by the way, and probably better than we told you last time. But last time we said more like 2019. I forget what that number was, but plug in a number a little bit north of 6.
That's your Bloomberg Business Flash. Back to you, Anna.
Simone, thank you. Simone Foxman there with the Business Flash. Coming up here on this program, a resolution after 17 years of dispute. The US and EU agreed to end their dispute over aircraft subsidies. We'll bring you the details next. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Welcome back to the European Market Open. 23 minutes into our European trading session, and European equity markets doing well. The Xetra DAX doing the best of the majors, up by 0.7%. President Biden is still in Europe, set for his first summit with the EU today. Yesterday saw a meeting of NATO with the alliance warning of China's growing military power. We're joined now by our senior writer, Stephanie Baker. And Steph, good morning, before we discuss NATO then and some of the news that came out from that, we just had these breaking news lines this morning. The 17-year Boeing Airbus dispute seems to have been resolved. It comes ahead of today's US-EU summit. What more do we know about that?
Yeah, this was one of the many hangovers from the Trump era, when the U.S. imposed tariffs on EU exports over Brussels' support for Airbus, and then the EU responded in kind with tariffs, sparking a kind of mini trade war. They appear to have agreed to put those differences aside, looks like with an eye on China again, which of course is backing its own aerospace manufacturer to grow and, potentially become a rival on the world stage. I don't think we know a lot of details about what exactly they agreed, whether or not state aid, which was at issue here, would be reduced or curtailed in any way. So, let's wait to see how this pans out.
What else is going to be on the agenda then for Biden's visit to Europe? Clearly, we've talked a lot about China, and they're just about managing to stay on the same page across the Atlantic on that front. What's on the agenda?
Well, I think all eyes are on Biden's meeting tomorrow with Russian President Vladimir Putin. He's come under some criticism for meeting Putin in the first place, saying that the meeting itself represents a victory for Russia at a time when, of course, there has been criticism of Russia for these ransomware attacks emanating from Russian territory, for the war in Ukraine. I think Biden has said he doesn't want conflict with Russia, but he's prepared to call Putin out on a number of things, and I think it reflects Biden's view that it's better to engage with your adversaries than, give them the cold shoulder. He clearly feels like there are things that he can achieve by doing that, either on arms control or climate change. Perhaps Iran will come up as well.
Yeah, so cybersecurity and the Nord Stream 2 pipeline, certainly a couple of things we are watching when we get to that summit. More on that as we approach tomorrow's summit then in Switzerland. Stephanie, thank you very much. Bloomberg Stephanie Baker joining us there with a preview of what we can expect from the EU-US summit and from the conversations between the US and Russia taking place a little bit later on this week. Coming up on this programme, funding the recovery. The EU kicks off with its biggest debt plan ever to raise 800 billion euros over the next 5 years. We speak to the Managing Director of the European Stability Mechanism, Klaus Regling, will get his expectations for what this can achieve, this big bond raising across Europe, and how do individual sovereigns manage their way through this as well. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Wednesday, the Fed decides. Will the Fed react to accelerating inflation concerns? Are members eyeing an earlier rate increase? Coverage begins at 1:30 p.m. on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Half an hour into our European equity session, and things looking bright across European equity markets. If you're long of these markets, you'll be pleased to see the Xetra DAX up by 0.7%, the FTSE 100 and the CAC 40 not all that far behind. US futures point modestly to the upside. Let's have a look at things from a sector perspective. And you can see that basic resources is a bit of a laggard. That's not really weighing too much, though, on the FTSE this morning. Basic resources down 0.4%. Energy and banks also under pressure. But we do see to the upside, chemicals are doing pretty well, and Air Liquide is one of the big stocks moving higher there, up by 2.4%. Linda also up by 1.4%, and AkzoNobel. So some heavyweight chemical stocks moving a little higher. We've had some positive notes out on Air Liquide, and that stock hitting a record high at 144.48 euros per share. Let's get a Bloomberg First Word News update. Here's Simone Foxman. Simone.
In England, the coronavirus lockdown will last at least another 4 weeks. Prime Minister Boris Johnson pushed back his plan to lift restrictions till at least July 19th. A more infectious variant has spread rapidly across the country. It threatens to undermine efforts to vaccinate the country's way out of the pandemic. Once again, there's concern that there could be blackouts in the two most populous U.S. states. Heat waves in Texas and California are threatening to push electrical grids to the brink. Texans are being asked to conserve power because a number of generating plants are offline for repairs. California's grid is being swamped with demand due to temperatures expected to hit over 110 degrees in the next few days. China is warning NATO it won't sit back in the face of any challenges. Beijing adds that the alliance should not exaggerate Chinese military power. The statement illustrates the potential for tensions to escalate. The United States is trying to convince its allies to take a tougher approach to China. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna.
Simone, thank you. Yeah, we continue to see news lines coming through from the Chinese Foreign Ministry as it pushes back against that G7 communique. Now, the European Union is kicking off its biggest ever borrowing program to finance its recovery from the pandemic. The bloc is debuting 10-year bonds as part of its next generation EU scheme to provide grants and loans to member states. Likely to price today, Commerzbank strategists expect the size of the sale to exceed 10 billion euros, and over the next 5 years, the EU is hoping to borrow 800 billion euros. For more on this, our Brussels correspondent Maria Tadeo is back with us with a key voice on the subject. Maria.
Yes,
Yes, Anna, good morning. Let's go straight with our guest. He is Klaus Regling, the Managing Director at the ESM. Mr. Regling, of course, today you're tapping markets for the first time. This is the initial sale of next generation EU bonds. That's the key to the recovery fund in Europe. And I wonder, what kind of appetite are you predicting for this product?
I'm sure it will be a big success. The European Commission is starting this program that could add up to 800 billion over the next 5 years, but they already got almost 100 billion from the markets to finance the SURE program last year and early this year, and all that was very successful. So I'm sure this first big issue, 10 billion or more for today, will also be a success. The appetite of international investors around the world is there. We had an investor video conference, European Commission, European Investment Bank, and myself from the European Stability Mechanism earlier this week, and we could see that international investors are very happy with these bonds coming out of Europe.
Right, and when you say international investors are happy with this debt coming out of Europe, what is it that they want? What is it that they're looking for in this product? Is it a safe asset? Is it perhaps a yield that's not like the German bond that may actually give you something? What is it that they appeal to?
Well, first, international investors want to diversify their assets like every investor. So they don't want to put everything into US dollar or other currency. Also, they want a big chunk in euro because confidence in the euro is very strong at the moment. When I compared with what I saw 10 years ago, it's just very, very different. So people are happy with how Europe has reacted to the crisis, how the euro area is developing. The forecasts are good. The response to the pandemic was effective and appropriate. So confidence in Europe is there. And indeed, I would call it a safe asset. Bonds issued by the European Commission, like the bonds that are issued by the European Stability Mechanism or the EIB, and investors can pick up about 30 basis points higher yield than German bonds. So all that makes it very attractive.
Right, and I'm sure that's a point that gets taken into consideration. And Mr. Regling, just to wrap on the issuance, I wonder, you have to issue a lot of bonds this year. That's 80 billion euros, 150 on an annual basis from now on until 2026. Do you worry perhaps that the market is becoming a little bit too saturated? I mean, because on top of this, you also have the national sovereign bonds that also need to tap markets. Can you find the right window for each product?
Yeah, and of course, I'm not doing that. This is the European Commission. What's happening today? We have our own issuance program. I don't expect any problem in today or in the near future. We all talk to each other. We coordinate with the national debt offices. It is correct that debt issued by European sovereigns and institutions is much, much higher than last year or 2 years ago. This is true also for all countries around the world. In response to COVID-19, all countries have had to increase spending and fiscal deficits and therefore have to issue more debt. But at the moment, also as a result of the monetary policy of the ECB, the Fed, and other central banks around the world, this is not a problem.
And Mr. Regling, of course, we've talked about the European economy in the past too. Now we've seen vaccinations really pick up in the past few months. How bullish are you in this recovery?
When I look at the forecasts coming out from international institutions like the OECD or the European Commission, IMF, but also what I see in the markets, forecasts from market analysts, they all agree basically that from the second quarter this year, so right now, we see a very strong recovery. First quarter was still weak, in some countries negative because of the lockdown and response to the third wave. But from now on, the expectation is that it is really strong. And the ECB came out with a forecast last week. They expect 4.6% growth for the euro area this year, 4.7% next year. And that would imply that by the first quarter of next year, the euro area GDP would be back to the December 2019 level, just before COVID-19 hit all of us. Of course, there are risks, but the risks are balanced. There are upside risks. It could be stronger depending on accumulated savings spent even faster. Downside risks coming from new variants. And your program a few minutes ago talked about the United Kingdom postponing the lifting of the lockdown by another month. And there's unfortunately a reason for that. So these are risks which exist, but the baseline scenario is very strong in all the forecasts that I see.
And just as a final question, how much do you worry about inflation? Because, I mean, today, of course, it's this new auction that's hitting the market. We're talking about next generation EU. But I wonder, you know, if you're an investor, should you worry about inflation, especially if you're in the fixed income space?
Sure, there's a lot of talk about that. And it's good to remember that central banks around the world, including in Europe, have been working very hard to bring inflation up. And I think that we will see that in the next 2 years or so. In the US, maybe one should need to worry a little bit more than in Europe, because there the stimulus is very much focused on the demand side, very much this year, while in Europe, our economic support programs like Next Generation EU are designed very differently. Money will be spent over the next 4 years. And the money will be used not only to stimulate demand, but also to strengthen the supply side of the economy. And therefore, I think inflation worries are much less in Europe than they are in the US, where we know that some prominent economists are actually quite worried. But that's not the situation in Europe.
Right, Mr. Regling, thank you so much for joining us on Bloomberg. And again, congratulations on that bond sale that we're expecting will be executed today. Thanks for joining us. Anna?
Maria, thanks very much. Our Brussels correspondent there. Maria today with Klaus Regling, Managing Director of the European Stability Mechanism, as we see that massive bond raising taking place in Europe, just beginning at least. Now, coming up, as England delays, we just heard Klaus underline this point, as England delays its reopening, where next for the struggling hospitality sector in the UK? We speak to the London Mayor's nighttime czar, Amy LeMay. That interview next. This is Bloomberg.
during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European Market Open. 43 minutes into our European trading session, and we see gains across European equity markets up by 0.7% on the Xetra DAX. The chemical sector doing particularly well today. Now, England's Freedom Day, as it has been called, seems to have been delayed. As expected, Boris Johnson yesterday announced he was pushing back, lifting virus curbs by a month. That's amid concerns over a rapid rise in COVID cases as the highly contagious Delta variant spreads. But the Prime Minister reassured weary Britons that an end is in sight.
On the evidence that I can see right now, I'm confident that we will not need more than 4 weeks, and we won't need to go beyond July the 19th. It's unmistakably clear the vaccines are working, and the sheer scale of the vaccine rollout has made our position incomparably better than in previous waves.
We're joined now by the London Assembly's Night Czar, Amy LeMay. Amy, very good to speak to you and to think about what impact this is going to have on the nighttime economy of London. I mean, obviously, this is bad news for the sector that you think about, the sector that you're very fond of and that you represent. But 4 extra weeks, this sector has been pretty much closed for 15 months. Is this really going to be make or break, or are we already partly broken for some parts of this sector?
Hi, Anna. It's great to be with you. The delay to restrictions being eased is a real blow to many businesses and London's nighttime economy. So many of our hospitality, culture, nightlife industries are struggling to survive with reduced capacities, while our world-renowned nightclubs have been completely closed for more than 15 months, as you say. And they're all desperate for restrictions to be lifted as soon as possible to help get businesses back on track. And they have been planning for months to be ready for next week. We are in danger, let me be clear, we are in danger of losing countless businesses, jobs, and livelihoods. So it's absolutely essential that the government provides urgent and comprehensive financial support to help businesses through this further period of uncertainty. And this means extending the full business rates holiday. It means extending the evictions moratorium that is meant to start at the end of this month, extending the existing furlough scheme until all restrictions are lifted, and an extension of the cultural recovery grant. So every day that social distancing rules remain in place, it pushes more businesses in sectors like culture, hospitality, and nightlife to the brink of collapse. And any reduction in financial support at the end of June will have dire consequences for jobs and for livelihoods.
And Amy, are you hearing from the government that there is any movement on that? I mean, the furlough scheme is still in place until September, but of course there's a taper that does start to be introduced through July. Now that things have changed, now that the date of full reopening has been pushed back, are you hearing that there will be a continuation of those fuller levels of support for the sector, for the economy as a whole?
We saw what the Prime Minister announced last night, and that is all the information we have. We are continuing to press government for this, but quite frankly, the industry and leaders around the UK were shocked that the Prime Minister did not announce any extension of financial support for the industry. The sector needs to be supported so that they'll be able to open their doors again when it is safe to do so.
Of course, this date, well, the previous date, June 21st, Amy, was always cast as a not before date. And so there was always the opportunity, or the possibility rather, that this could be delayed. Now we've seen it be delayed. Prime Minister Johnson, though, painted July 19th in a very different light, though, last night, suggesting that this would be a much firmer date. How much do you sense that the sector will be planning ahead more firmly towards July 19th?
Well, the good thing about the hospitality and nighttime and culture sectors is that they're very resilient and they're innovative. So they will make the adjustments necessary. But let's be clear, these businesses need the support. They need the financial support in order to be there, to be at the very heart of our social and economic recovery. I mean, the latest data shows, we've started to see a small increase in the number of COVID patients here in London hospitals. They're still very low compared to earlier in the year, but it's clear the data is going in the wrong direction. And we all want to see restrictions eased as soon as possible to allow more businesses to open again. So it's important that the government ensures that London has the vaccine supply and the resources needed to vaccinate everyone who needs it. But also, we need the government to realize that our nighttime businesses are central to our social and economic recovery to the pandemic. So that is why the government needs to provide that urgent, comprehensive financial support to help them through this further period of uncertainty.
Amy, I read that some in the nighttime economy are thinking of taking legal action. Is that something you're aware of? Is that likely to deliver?
I am aware of it, and we're watching to see what happens. But I think regardless, the nighttime businesses are really great at innovating, and they're also very good at following strict rules. I mean, they do this as par for course. Even before COVID, they were adhering to strict rules around licensing and health and safety. So given half a chance to survive, they will be at the heart of our recovery. We just need the government to step up. Yeah, again, they said that they would do anything necessary. We need them to help us over the line. If it's going to be another 4 weeks, we can accept that, but we need that support.
Whilst I have you, Amy, I wanted to ask you about something else. You launched the Mayor's LGBTQ plus venues charter, and we are in Pride Month, even though many of the venues you represent are not able to be open. Pubs, of course, are open. The Mayor is committed, we understand, to provide an annual audit. I wonder what you're discovering about the provision of these types of venues in London.
Yes, well, it's a very interesting question because we established the LGBTQ plus venues charter and the LGBTQ plus venues forum to help these venues become more resilient, share good practice. And we saw between 2006 and 2016 a 62% loss of our LGBTQ plus spaces in London. So the Mayor and I have been committed to turning that around. We've had no net loss. We have contributed a lot of support to these venues. We know they're at the very heart of London. And if we lose these venues, we lose something very special that London has. They're a beacon of hope for so many communities, so many people. And so we need to carry on with that support. And we're just doing everything we can to make sure that those venues are there to be part of our recovery on the other side.
Amy, thanks very much for joining us. Amy LeMay, Night Czar for the London Assembly. Thank you very much for joining us here on the European Market Open, 8:51 here in London. Coming up, European stocks continue to shine. That's as investors look ahead to this week's Federal Reserve meeting. We'll get back to the macro themes we're dealing with this week with the Market Live team's Laura Cooper, who's with us next. This is Bloomberg.
rise again.
Broadway's returning.
June
Have you bought tickets?
is busted out.
You've got more time here. If you want.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open, 8:54 in London, so 54 minutes into a strong European trading day for European equity markets, up by 0.7% on the Xetra DAX. European stocks continuing to shine then this morning. That's as investors look ahead to this week's Federal Reserve meeting. Laura Cooper, Bloomberg's Markets Live macro strategist, is with us. And Laura, what do you sense is really driving these gains? We still sit here with very low interest rates, with the US 10-year yield still down at 1.47%. For as long as that is the case, does that give a sort of green light for stocks to carry on?
Well, I certainly do think that's the case. You know, there's expectations that we are going to see a dovish Fed tomorrow, and that's really giving the green light to equities, extending their gains. And I think in particular in Europe, the narratives remain unchanged. We are seeing that conviction of the European growth recovery. We are seeing inflation expectations are expecting to kind of climb even higher. That tends to correlate quite well with a number of sectors across Europe. And we do see still deep discounts across a number of low cyclically oriented sectors in Europe. So kind of the combination of all of those, it's no wonder why we are seeing European equities, notably the Stock 600, on its extending its potential 8th consecutive day of gains. That's the longest streak since 1999.
Yes, and that maybe send us all out to party, socially distanced, of course. Let me ask you about the US data then. We've got PPI numbers coming out later and some other data, I think, from the US.
Yes, we had U.S. retail sales today, which typically would be, potentially market moving. But I think at this point, it's just adding noise to the narrative. I think at this point, Fed members have made up their mind about how tomorrow's outcome is likely to happen. And so I do think at this point, the Fed is unlikely to really see that substantial further progress needed to officially signal any kind of tapering timeline tomorrow or have a material change in their language. But I would expect some potential hawkish tilts tomorrow, notably around that dot plot. The bar is so low for that 2023 to now show a hike. And so I really think the outcome tomorrow is what markets are going to be focused on and less so about that potentially noisy data today.
Laura, thanks very much. Laura Cooper, Bloomberg Markets Live macro strategist. Thanks very much for coming to talk to us here on the European Market Open. European equity markets then pointing to the upside or moving to the upside this morning. Chemicals doing pretty well still. That is one of the best gaining sectors this morning. To the downside, though, the banking sector losing ground. HSBC down by 1.5%. Hard for London to make as much ground as the others with that the case. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Crypto is a nuanced issue, and it's possible the U.S. gets crypto wrong.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I'm confident that we will not need more than 4 weeks, and we won't need to go beyond July the 19th.
I think crypto is the next internet-sized opportunity for the United States.
Russia that is not acting in a way that is consistent with what we had hoped.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 15th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. War and peace. NATO warns about China's rising military ambitions as the U.S. and the EU end their 17-year dispute over aircraft subsidies ahead of today's summit in Brussels. End of the COVID boom, Jamie Dimon signals a trading revenue drop of more than a third after last year's record numbers. Meanwhile, Goldman Sachs leads the return to office race on Wall Street. And the UK ends the COVID restrictions for 4 weeks in England. This as both AstraZeneca and Pfizer vaccines are shown to be more than 90% effective at preventing hospitalizations from the Delta variant. So good morning, everyone. China's rising military ambitions present NATO with challenges that must be addressed. That's according to the alliance, marking a shift in its stance that could kindle confrontation with Beijing. The Secretary General Jens Stoltenberg heralded the speed at which the group stepped up the meeting of the threats.
We are concerned by China's coercive policies, which stand in contrast to the fundamental values enshrined in the Washington Treaty. China is rapidly expanding its nuclear arsenal with more warheads and a larger number of sophisticated delivery systems.
Well, China has responded to NATO's communique. Through a statement by its mission to the European Union, Beijing says it doesn't pose systemic challenges to any nation, but it would not sit back if any country poses such challenges to China. Well, joining us now with more is Bloomberg's international government executive editor, Ros Matheson. Ros, thank you so much for always making the time to come on, because I know you have a very busy day. But has the alliance now been reinvigorated?
Well, you can see the shift in NATO, at least from the Donald Trump presidency, when, of course, Trump frequently questioned NATO and particularly the commitments other countries were making to. And, of course, the French president famously called NATO nearly brain dead only several years ago. So the tone at the summit this week has been markedly different, one of presenting a united front as much as possible, talking about common threats, not just China, of course, but also the big one in Europe's own backyard, which is Russia, and talking about working more collaboratively to confront those challenges, and of course also trying to paper over some tensions that NATO has had in recent years with one of its key members, which is Turkey. So you can see, at least on the surface of it, an effort to say we're working on these issues together. Of course, the reality is that the way that they may see themselves needing to manage those relationships is quite different still.
Roz, ahead of the US-EU summit, we're also reporting that the two sides are set to end the 17-year Boeing-Airbus dispute. What do we actually know about it?
Well, that's right. This was something that's been flagged for a couple of weeks now. We could see movement towards a resolution and a real desire to put this thing to bed. Of course, it was affecting about $12 billion worth of tariffs and really hitting both countries, arguably, and both companies, arguably, quite hard. And again, a recognition that that doing so would arguably weaken both Airbus and Boeing at a time when you've got Chinese aerospace companies really pushing outwards and expanding their influence into other parts of the world. And is this a time to be having your own sort of big marquee state companies in trouble? So there was a recognition there that they really needed to put this dispute aside. And as part of that, again, that sense of you want to cooperate with China on certain things, but you really need to compete with them economically. So it looks like they've decided to reach a resolution on that one. It should be announced later today.
So what else do we know? You know, on the Biden agenda, basically visiting Europe, he has a pretty packed agenda. Tomorrow he's also meeting in Geneva Vladimir Putin. What do you think, Roz, will be his toughest day?
Well, the biggest thing, of course, in all of this probably has to be his sit down tomorrow in Geneva with the Russian President Vladimir Putin. There's a lot riding on that for him, less so for the Russian leader, because really he gets the win just by having Biden show up and shake his hand, and the recognition that he's looking for. For Biden, there's opportunity in meeting the Russian president, but also a fair amount of risk. He has to come away potentially with some sort of tangible to show for it, and also the sense that he is standing up to Vladimir Putin over various issues that the US is concerned about, including ransomware attacks. So there's quite a lot of pressure on him to show something from this, more than we just agreed to sort of diffuse tensions in the short term, perhaps some gestures on either side. But he has to balance the way that he's perceived at the end of that meeting. So that's probably the biggest thing on his plate for this whole swing through summits in Europe.
Roz, thank you so much. Bloomberg's executive editor there for international government, Roz Matheson. Now, England's Freedom Day has been delayed. As expected, Boris Johnson yesterday announced he was pushing back lifting virus curbs by a month. That's amid concern over a rapid rise in COVID cases as the highly contagious Delta variant spreads. Meanwhile, data out this morning also shows that UK payrolls surged the most on record in May. Now, companies stepped up hiring as coronavirus lockdown rules were being eased. While Bloomberg's UK economy reporter Lizzie Burden now joins us. Lizzie, good morning to you. So what did the UK jobs data show actually this morning?
Well, the UK added jobs for a sixth month and vacancies climbed 16%. In May, remember, this is the month when restaurants and cinemas reopened, so that's explaining the surge in demand for jobs in May. It could be a different story in June, though, because of this delay to the reopening.
Lizzie, this extension is as devastating for certain sectors, but what does it mean for the economy in general?
As you say, it'll be a blow to certain sectors, mainly because of the continuation of social distancing rules, which will severely curtail earnings, especially in hospitality. This is meant to be the peak season for that industry. But despite the postponement of easing, the government isn't planning to extend support for businesses. The furlough scheme, for example, still will be tapered as planned. And that's despite the warnings of hospitality bosses that hundreds of thousands of jobs could be lost in that sector. And so the government could be allowing this because of the labour shortages in various sectors. It could be allowing people to move around the economy, but also it's going to save on the ballooning cost of furlough. It'll be really bad for hospitality, arts, entertainment, travel. But away from those sectors, economists have been expecting a 2 to 4 week delay. The mobility and confidence in the economy is recovering despite the restrictions. So overall, it might not actually be that big of an economic hit.
Thank you so much, our UK economy reporter there, Lizzie Burden. Now, we're also just getting some breaking news in terms of a free trade, if I could get my words out. Happy Tuesday, everyone. The UK saying that there's a free trade deal agreed with Australia, that, for example, this deal will boost car, whiskey and confectionery industries, and it also eliminates some of the tariffs that we've seen on Australian wine being imported into the UK. So we'll watch for that, and of course it will benefit specific industries as well. Coming up, inflation has been on everybody's lips as economic stimulus wrestles with tight supply lines. Opinions remain divergent, and millions of missing jobs could also make inflation hawks think twice. So we'll have the details on that next. This is Bloomberg.
enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the future of inflation is being hotly debated as economies continue down the path of reopening. As the argument rages on, the Fed begins its two-day meeting with the subject on everyone's minds. Well, joining us now is Geraldine Sundstrom, portfolio manager at PIMCO, focusing on asset allocation strategies. Geraldine, as always, thank you so much for coming on. When you look at inflation, and this is really anyone really talks about in the markets, it's unclear if we do see stronger inflation and if the Fed is wrong, when we would see it. So first of all, Geraldine, do you believe, like the market now seems to, that actually any spike in inflation is temporary?
Well, anyway, for base effect reason, there would be a time when inflation will go lower. The uncertainty around forecast at the moment is particularly elevated. We are going through something that's really unprecedented. It's likely that inflation will remain elevated for a few more months, but after that, we definitely see things, coming down. All the more than looking into 2022, the fiscal stimulus, the monetary stimulus is going to be withdrawn around the world. So economies should slow down pretty much, even though we still see them growing above trend. So ultimately, inflation should get back into a reasonable level after a couple of quarters, most likely.
So when you look at the possible overheating economy, do you worry about the U.S., Geraldine? But is it a worry that we should think about in Europe, or is Europe just completely different?
Excess saving capex plans are pretty strong, I would say, in a quite generalized manner. Of course, in the U.S., maybe the fiscal stimulus has been stronger. Excess saving are particularly strong as well. So if there were to be a place, the U.S. would certainly be ahead of Europe in terms of risk. Yes.
Geraldine, overall, what's your biggest concern when it comes to asset allocation? So is there something apart from inflation that we could be misreading?
Of course, markets have moved, have really embraced the recovery. We know that taper is going to come at some point. It's well telegraphed. It would seem that the situation in many ways is very different from 2013. But there will, of course, always be a bit of nerves around. We don't think it will derail anything from a fundamental standpoint. It's much more, markets with a volatile tendency because, the injection of liquidity will start to slow down. But we think it's going to be well telegraphed. It's going to be very gradual. And with growth being good, with pent-up demand being good, risk assets should do fine.
Is there value in emerging markets? Or how do you split it, Geraldine? Where do you choose to put your money right now?
So in terms of equities, we're looking at it much more from a sectoral standpoint and making a difference between what is sustainable and what is a one-off. And certainly there are some sectors which are going to be secularly supported, that have pricing power, that have barriers to entry, where we still find good value in terms of semiconductors, forest, AI, automation. There's a number of sectors, even maritime transport for that matter. So we're looking at this in this way. There are other areas which, of course, are much more one-off, that are going to be more ephemeral, and where we choose not to be so present. In terms of fixed income, I'd say in credit, we like still the reopening trade. There's still some room to go, but we are tending to be much more into the securitized part of the market, because credit spreads, generic credit spreads, are becoming quite rich.
Geraldine, in terms of equities, does technology at the moment look expensive, or are there parts of the market where you could still see prices rising?
I would differentiate the hardware from the software. So when we look at hardware, I would say this is our favorite part of the market in terms of semiconductor equipment, machine vision, automation, and this part of the tech we feel is highly attractive. The software internet part, we're a bit more cautious because it doesn't really go necessarily well with the reopening trade, but also regulation is becoming harsher from China to the United States via Europe. So we distinguish between the hardware and the software, and in the hardware we certainly see quite attractive valuation. In fact, is all the more than the pricing power pendulum seems to have moved from the software to the hardware manufacturers given scarcity.
Geraldine, on the back of what we heard at NATO and the fact that actually, they were talking about the Chinese military, that China responded through their envoy saying that they are watching this very closely. Are the supply chains, because of the Trump era, now moved and so, can't move more? Or could that be a disruption that could also hit some of the industries that you're looking at?
So there will be disruption for sure in strategic areas, I would say mostly in the technology as well as probably in the pharmaceutical industry, which we think a bit about less. However, you have to look at this probably as an opportunity in the sense that for this strategic sector, be it in China or the United States or Europe, they are trying to create very welcoming and very supportive environment in terms of subsidies, in terms of taxation regime. And this means more investment than anything else equal. And that's why we like the semiconductor equipment makers, because we will, countries and region want to reshore production away from Asia or even Taiwan for that matter because of tensions with China back into the United States, back into Europe. So everything else equal, this means more investment and a more friendly environment from the part of government. So this should be seen as an opportunity in that case.
Geraldine, thank you so much. Geraldine Sundstrom, their PIMCO portfolio manager. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Here in England, the coronavirus lockdown will last at least another 4 weeks. Prime Minister Boris Johnson has pushed back his plan to lift restrictions until at least July the 19th. A more infectious variant has spread rapidly across the country. It threatens to undermine efforts to vaccinate the country's way out of the pandemic. Once again, there is concern that there could be blackouts in the two most populous U.S. states. Heat waves in Texas and California are threatening to push electrical grids to the brink. Texans are being asked to conserve power because a number of generating plants are currently offline for repairs. California's grid has been swamped with demand due to temperatures expected to hit over 110 degrees Fahrenheit in the next few days. And China is warning NATO it will not sit back in the face of any challenges. Beijing also said that the alliance should not exaggerate Chinese military power. The statement illustrates the potential for tensions to escalate. The US is trying to convince its allies to take a tougher approach to China. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, coming up, stocks in the green again after the Nasdaq closed last night at an all-time high. More on the markets next with our Danny Berger. This is Bloomberg.
particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I do think we're going to have higher inflation, but I don't think it's going to run away the way some people do. And to that end, I think bond yield will move higher, but not to unattractive levels.
Well, that's KKR's head of global macro and asset allocation, Henrik Vey, on inflation risks. Now let's get straight to the markets with our very own Danny Berger. Hi, Danny. Tomorrow's FOMC meeting, the big event of the week, but we also have retail sales and PPI out today. What does the setup actually look like for the markets?
I have to say, Francine, I feel like the market's sort of sending the same message as KKR there. That is that it's looking through what's expected to be a spike in inflation in today's PPI numbers. You can see really those concerns aren't there when you look at what equities are doing. We have this stark outperformance of growth stocks. So you have the NASDAQ 100 yesterday hitting all-time highs while Russell 2000 shares fell. You can still see that outperformance in today's future prices as well. Yields perhaps more so pricing in more moderate growth relatively, so a bit of a disconnect there. But really, I think that retail sales figure is going to be interesting because while market participants might be saying we're not worried about inflation, a question that arises is whether the consumer is. And this is something that Sebastian Gailey from Nordea flags as a potential risk. If retail sales come in really weak, if volumes are low but prices are high, it shows that the consumer has issues with those high prices. And that in turn might cause the Fed, might cause the Treasury Department to reassess their view on the economy. So again, I do think that that retail sales figure will be really interesting today, despite the fact most people are really looking forward to tomorrow's FOMC, Francine.
Yeah, Danny, there were a couple of things in the Chinese market. I mean, I think they had concern about liquidity, so I don't know if you think, that's something that we need to watch out for here in Europe as well. And then metals were down.
Yeah, that's right. And I also think that, so metals partially about that China story and concerns about liquidity and demand, but also about that inflation fear receding. So we're not seeing metals priced as high as they were.
Danny, thanks so much. Our Danny Berger there with the full roundup, of course, of what we're watching today in the markets. And then Danny's back also for a full roundup of what we could see amongst bank earnings. Now let's take a look at some of the other things that we're watching out for today. At 10 a.m. UK time, we'll have Euro area trade balance figures. At 1:15 p.m., the Bank of England Governor Andrew Bailey due to speak at the Citi UK annual conference. And then this afternoon, we'll have data from the U.S., including PPI and retail sales. Of course, keep an eye on the EU-US summit in Brussels with President Joe Biden attending, plus the UK Prime Minister Boris Johnson will also hold a bilateral meeting with his Australian counterpart, Scott Morrison. I think we had breaking news in the last couple of minutes that actually they came to a trade agreement. And then Oracle Corporation is expected to report earnings for the first fiscal quarter. Coming up, resolution after a 17-year dispute. The U.S. and the EU agreed to end their dispute over aircraft subsidies. We'll bring you the details next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
War and Peace, NATO warns about China's rising military ambitions as the US and EU end their 17-year dispute over aircraft subsidies ahead of today's summit in Brussels. End of the COVID boom, Jamie Dimon signals a trading revenue drop of more than a third after last year's record numbers. Meanwhile, Goldman Sachs leads the return to the office race on Wall Street. And the UK extends COVID restrictions for 4 weeks in England. This as both AstraZeneca and Pfizer vaccines are shown to be more than 90% effective at preventing hospitalizations from the Delta variant. Well, good morning, everyone. I'm Francine Lacqua in London. Welcome to Bloomberg Surveillance Early Edition on Tuesday, the 15th of June. Now, China's rising military ambitions present NATO with challenges that must be addressed. That's according to the alliance, marking a shift in its stance that could kindle a confrontation with Beijing. Secretary General Jens Stoltenberg heralded the speed at which the group stepped up to meet up threats.
We are concerned by China's coercive policies, which stand in contrast to the fundamental values enshrined in the Washington Treaty. China is rapidly expanding its nuclear arsenal with more warheads and a larger number of sophisticated delivery systems.
Well, China has responded to NATO's communique. Through a statement by its mission to the European Union, Beijing says it doesn't pose systematic or systemic challenges to any nations, but it would not sit back if any country poses such challenges to China. Well, joining us now from our Brussels bureau is our correspondent, Maria Tadeo. Maria, great to have you on the program. What actually came out of NATO yesterday?
Well, Francine, first of all, there was a very clear pledge that NATO is still a very relevant institution, that this is an alliance that sees a future. And when you speak to the American delegation, that is something that they wanted to really present and cement this idea that the U.S. will always honor what they now call their sacred duty to protect NATO and Article 5. When you look at the Europeans, it was still very much the same line, to say we want to work together and we want to protect our allies. Of course, we know that on paper, there's still differences when you look at what the Germans believe, when you look at the French, when you look at President Erdogan, also of Turkey yesterday. But overall, it was very much a session designed to send a message to both China and Russia, saying NATO is still very united. On China, as you said right there, they were very explicit. The Chinese, they're an economic power, but they could also turn into a military power that could be a threat to the global order. And when you look at the communique, Russia was mentioned many times as now as a country that is aggressive to its eastern neighbors, that could pose a threat to countries like Ukraine, Moldova, but also Poland and Lithuania.
We will not be divided. And that, I think, happened too many times over the last months, was that the United States and Europe were basically split apart. Right. That, I think, is not going to happen that easily anymore.
And that's what's Francine, the Belgian Prime Minister, as I said, the Europeans repeated this line that we're staying together and we're not going to be divided, especially when you look at the Eastern European neighbors who do feel that the situation when it comes to Russia has really escalated over the past year, especially as troops have been moving into the East.
Maria, thanks so much. I'm Maria Tadeo there from Brussels with the very latest, of course, on what's been happening in NATO. Now, joining us to discuss this more in depth is Anthony Gardner. He's former U.S. ambassador to the EU. Ambassadore, thank you so much. I know you speak like a million languages, which always really impresses me. I think that's what you have to do when you're an international man of mystery. When you see the President Biden's agenda and what exactly he's here to do in Europe, what will be his most difficult day? He went from the G7 to NATO to this EU summit, US-EU summit, and then to meeting Vladimir Putin tomorrow.
Well, the most difficult day will be meeting Vladimir Putin, clearly. But these trips are very important because they are of symbolic significance, given what happened in the last 4 years during Donald Trump, particularly with regard to the EU, because the prior administration thought the EU was essentially a waste and not effective. This administration considers, in my view, appropriately, the EU is actually a critical partner. So that summit is going to be very important. I welcome the fact there's going to be a Boeing-Airbus agreement. I haven't seen the text yet. There are going to be some interesting discussions in there about what kind of subsidies are going to be covered going forward. And there's going to be some difficult conversations as well about what about those aluminum and steel tariffs. And that's a difficult domestic political issue for the president, but I think there is a way forward on that topic as well. But clearly, the discussion with Putin is going to be very direct. I suspect there's a lot of unfinished business, Francine, in the last administration. So I believe that Biden will say, look, this time, unlike the last 4 years, I stand shoulder to shoulder with an alliance, and we will respond seriously.
Ambassador, when you look at some of the, what the U.S. actually needs the EU for, is it to deal with China and Russia, or is it just to try and go back to an older, normal world order?
Will rely or hope to work with the EU on many areas, but China clearly is the acid test. Now, some in the EU and member states don't want to hear that message. They keep on saying, yes, of course, we're going to work with you on China, but we see China a different way. The fact of the matter is, politically, it is the acid test. That's the way Congress looks at it. Many U.S. voters will look at it. What good are allies, including the EU, if they're not going to work with us on the key challenge going forward? The EU likes to say we want to work within the rules. Of course, we want to work within the rules, too, in institutions like the WTO. But rules are just not going to be enough, Francine. It's going to have to also mean sending China some very clear messages. We saw that coming out of NATO. I hope we see it coming out of the EU as well. The U.S. and the Trade and Tech Council will be very much part of that. The supply chains will be part of that discussion as well, reducing our reliance on China. And also, how do we get significant WTO reform?
Does China retaliate? So what's the best way to actually deal with China?
Well, one of the best ways is actually finally working with our allies, and this is what this is all about. In the old days, under Trump, it was bilateral, transactional, one-on-one with China, because the EU thought that the EU was a distraction. But if we work with our allies, particularly the EU, and let's remember, the EU is a trading and regulatory superpower in those two areas, it's much more effective to go to China and say, this is what we're going to do. We're going to bring more cases against you, but we're not just. We're actually going to close our markets to you if you don't open up your markets and open up your investment practices. So it's a much more effective way of proceeding, and I think the Chinese understand that very well. Remember, they've been looking for years at ways of dividing Europe internally and dividing Europe from the United States.
Ambassador, what does Russia actually need from the U.S. tomorrow?
What do they need? Well, I think they're getting what they want, which is a recognition that Russia's a player, that the United States takes Russia seriously, and hence this meeting, the summit. And clearly, they're a player in some parts of the world, and we can cooperate with them on some areas of important issues like climate change and so forth, and also the Iran agreement. So they're getting what they want, but I think the message will be, no more election interference. You have to control these bodies that are operating in Russia. Sometimes with state approval, and sometimes, the state is looking the other way. Bodies that are, putting out a lot of disinformation that's repeated in our media. So there's going to be some strong discussion about that.
But does Vladimir Putin, what's the incentive for Vladimir Putin to kind of, heed the warnings and maybe temper what's been happening over the last 4 to 5 years?
Well, to date, we've done rather modest things in response to Russia's aggressive behaviors. I mean, expelling a few diplomats, of course, means nothing. But if we can work with our allies in tightening the sanctions we have in place on Russia and doing things which are asymmetric, you know, releasing information onto social media about exactly what the Kremlin is doing with its cronies, it's the kleptocratic nature of the regime, embarrass Putin if necessary, or engage in cyber activities to send a message that we too can play this game. That will send a very strong message. So no more business as usual of these modest half measures. And we should even consider sectoral sanctions if the EU is ready to go along. That's always a big problem. Under my time as ambassador to the EU, it was very difficult, even after the invasion of Ukraine, to get all of the EU member states to act. But we finally did. Remember, we finally did, late but quite effectively.
Anthony Gardner, thanks so much for joining us today, former U.S. ambassador there to the EU. Now, coming up, there's good news on the vaccine front. Those who have had 2 doses of either Pfizer or AstraZeneca shots appear to be well protected against the Delta variant. We'll look at what's happening exactly in the UK. We'll look at variants and vaccinations. Next, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics, and of course the virus. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this hour, we've had confirmation, first of all, that the UK-Australia free trade deal is happening. This is the first major bilateral trade deal that the UK has brokered since it left the European Union in January 2020. Downing Street says the deal with Australia will boost its bid for the CPTPP. Really rolls off the tongue as it seeks to strengthen trans-Pacific relations post-Brexit. Now, we'll have plenty more, of course, on that. We'll look at currency moves, but let's get straight to the Bloomberg Business Flash. Here's Leanne Gearns. Hi, Leanne.
Hi, Francine. Emirates has slumped to a record $6 billion loss in the financial year to March as the pandemic disrupted travel. The state-owned airline received a capital injection of $3.1 billion from its owner, the government of Dubai. As a result, Emirates has has been hit especially hard with the border closures related to the coronavirus pandemic. Now, Dan Loeb's hedge fund, Third Point, is said to have built a substantial position in Vivendi and is examining the French company's plan to sell a 10% stake in Universal Music to Bill Ackman's blank check company. Several of Vivendi's minority shareholders have really voiced opposition to this deal, but sources say Third Point has not given its opinion on the transaction just yet. Vivendi's spin-off of Universal Music goes to a shareholder vote on the 22nd of June. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, AstraZeneca's antibody cocktail has failed to prevent COVID-19 in a recent study. It was found to be only 33% effective at preventing COVID-19 symptoms in people who had been exposed to the virus. Now, the trial, named Storm Chaser, is one of the 6 advanced stage studies AstraZeneca is running to test the medicine. Meanwhile, there was some good news on the vaccine front. Now, according to health authorities in England, shots from Pfizer and AstraZeneca are highly effective at preventing hospitalization of those infected with the Delta variant after 2 shots. Now, the Pfizer shot is 96% effective against hospitalization after 2 doses, while the AstraZeneca shot is 92% effective. The results are comparable with the protection offered against the Alpha variant, which first emerged in the UK. Joining us now is Sam Fazeli, Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Sam, great to have you on the program because I have 1,000,001 questions about exactly what we're living through. So first of all, it seems that the UK is being kind of stonewalled by the EU because we have genome sequencing, because the cases are rising. So first of all, is the situation much worse in the UK than it is in Europe? Or is it that just we measure things differently?
No, it definitely is worse than it is in Europe in terms of the resurgence of the cases, because we were doing fantastically well. This Delta variant is we're the second highest country after India in terms of the percentage of cases. So it is worse, and we know much more about it because we do a lot more sequencing.
Right. But do other countries also measure if they have the Delta or the Alpha variant?
They do, but not at the same level.
Okay, so here, I mean, what, 90% of all cases are Delta variant?
We'll probably be 100 pretty soon.
And it's not more deadly, it just spreads more quickly.
More deadly is tough to say, but we do know that it's got about twice the risk of hospitalization than the Alpha variant. That's been now shown 2 or 3 times.
And so, why is that? So it's not only that you catch it easier.
You catch it easier, and it's also possible that somehow the biology of the virus or the way that it interacts with your body gets the virus in more places, gets you sicker, evades your immune system better when it first gets in, so you get a much bigger infection, you need to go to hospital.
So Sam, yesterday we heard from officials here in the UK that were looking at modeling, and the numbers really shocked me. They basically say that if we continue as it is, and if we open on the 21st of June, you'd have as many hospitalizations than we had back in 2020, like in April 2020, which was huge. It was over 3,000 a day. So is the only way, not opening further, but also even going back in lockdown?
Look, people will hate me for saying this, but I wish we'd stopped eating and drinking indoors in terms of restaurants and pubs. But you have to multiply a few things together. 50% more transmissible, twice as increased hospitalizations, so maybe you can multiply those two, although they're related. And it evades your previous immunity, and it evades vaccines more than the Alpha variant in terms of infections. So there's no question, therefore, that you just get a rampant rise, and exponential things are really awful to deal with.
But so what's the right strategy? So, apart from going back into some sort of lockdown, if I'm vaccinated 2 times, will I avoid the hospital?
But the data's saying you will, to the fact that there are still a few percentage of people who will be hospitalized, but that's what the data says. But Francine, our life is not driven by hospitalizations today, which is why I think that phrase started coming out. We have to learn to live with this. If you notice that phrase, well, probably the first time that I really heard it, I heard it anyway. That's the problem. We're counting cases, we run our lives by cases, we open and close by cases, we travel. You can't travel if you test positive. It's not saying if you're really sick. That's the problem we're dealing with now.
But I still don't understand. So you have vaccine passports in Europe where if I'm double vaccinated in France, I can go to Italy, Germany, and Portugal, no problem. But it's not the same with the UK. Will that ever change? Is it politics, or actually do the numbers make sense when you look at?
Yeah, I don't think it's politics. If you're a country that's half the way that the UK is in terms of numbers of double vaccinations, and you have the risk of having the Delta variant, why would you want that to start flying about when you've got to give yourself time to get to that 2 doses?
Okay, so why is the Delta variant stronger here in the UK? And actually, does the 12-week, which was a strategy of the UK, you give the first dose so that you touch as many people as you can, and then wait 12 weeks, was that wrong?
Well, you know, with hindsight, yes. But at the time, I was worried about exactly this. Then the data came through. It was looking fantastic. We cut hospitalizations and death, and now we have a variant. This is what we were worried about. Either the one dose on its own causes the variant to evolve, or something comes along that evades it, which is what we ended up with.
All right, Sam, thank you so much. As always, Sam Fazeli there, our senior pharmaceuticals analyst for Bloomberg Intelligence. Now, for more on the Delta variant, make also sure you catch our Q&A with Sam later today. I'll be following and also probably asking, you know, the last 990 questions I didn't get to. That's at 3 p.m. London time today on T Live on the Bloomberg terminal. So if you have a Bloomberg terminal, you just type T Live and you can follow Sam's great Q&A. Coming up, back to the office, Goldman Sachs leads the pack when it comes to getting staff back behind their desks. But is it really a competition? We'll have plenty more on that. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, while European bankers are seeing a slow return to the office, U.S. banks are putting pressure on staff to get back to their desk. This week, Goldman Sachs is beginning its return to the office in earnest. The bank has also set a deadline last week for employees to report their vaccination results. Well, Bloomberg, or vaccination status, I should say. Bloomberg's Sonali Basak reports from Goldman's New York City headquarters.
Goldman Sachs is bringing thousands of its employees back to its offices across the United States, with some exception. However, for most employees, it will be back to a 5-day office work week. Thousands of interns will start for the first time in offices as well, while vaccinated employees across the country will no longer need to wear a mask. Those without vaccinations will still need to be wearing a mask at all times except for their desks. European offices will be close behind. Goldman Sachs expects to open offices in Europe as early as next week. Sonali Basak, Bloomberg News in New York.
Now let's get more with our Danny Berger. Danny, how do other banks actually compare to Goldman's when it comes to the return to work?
Well, there's definitely a divide when you look at UK European banks versus Goldman. Sonali there had mentioned that Goldman's going to start looking at opening some of their European offices. JP Morgan, Goldman's certainly looking at phasing in a return when it comes to Canary Wharf. But if you go to these places, they're largely empty at the moment, Francine. You have Barclays, for example, still talking about a phased return. No one's going to be mandated to come back in. HSBC is still looking at more of a hybrid model, giving up some of their office space. So yes, it really comes down to these cultural differences between the big US lenders and those in Europe. So we're unlikely to see any sort of even policy. We're unlikely to here in Europe to see something like Goldman Sachs, where I'm kind of jealous of Sonali yesterday, even though she was out there in the rain. I mean, it was like a festival. They had free food. They had live music. Francine, I'm still have yet to hear, though, whether or not Goldman Sachs played the latest hit from David Solomon, aka DJ Soul, who just released a single right before the offices reopened.
I know, I love that. First, I mean, the two things that shot. First of all, I love that song. I know our producer George doesn't, and I know Danny, you like it as well. So we have the same music taste. And then people are coming in at 8:30, which for news, for a news organization, I was like, that's quite late.
Yeah, it definitely is.
Danny, JP Morgan's Jamie Dimon is also warning of a steep decline to revenue after the pandemic boom. Have a listen.
Last quarter is exceptional. This quarter is what I call more normal, where you can plug in your model and make it really simple. It's like something a little bit north of $6 billion, which is still pretty good, by the way, and probably better than we told you last time. But last time we said more like 2019. I forget what that number was, but plug in a number a little bit north of 6.
So does this warning, Danny, actually come as a surprise to Wall Street watchers?
Well, we did see shares decline about 2% for JP Morgan. Other banking shares fell as well. So, it did cause a readjustment in markets. Perhaps not a full-out surprise, considering that banking executives had been warning about this really since the peak of earnings when it comes to trading revenue because of this pandemic boom. And Jamie Dimon himself went on to say that, look, it's not necessarily that the figures are going to be bad, but it's more of a return to normal. But still, we're in a situation where investors and traders are having to adjust. This is the first time they're really getting concrete numbers from JP Morgan of what the revenue is going to look like. So they're putting those into their models, and that in turn is causing a fall in these share prices because what he said was worse than what was expected, Francine.
Danny, thanks so much. Our Danny Berger there with the very latest on the banks. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin, Katie Lyons out of New York. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
China's growing influence and international policies presents challenges to alliance security.
When it comes to China, you've got to... I don't think anybody around the table today wants to descend into a new Cold War with China.
We are open for dialogue with China. We are open for business with China, but on elements of reciprocity.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong, and our top stories today. Tough talk from China. Beijing warns it won't sit back if it's challenged by NATO. A truce on tariffs. The EU and the US have agreed to settle the long-running trade dispute over Boeing and Airbus that has led to billions in duties on imports. And keep your distance. Boris Johnson's plan to lift social distancing rules in the UK have been delayed for a month because of that more infectious variant of the coronavirus. Now, of course, there's lots going on. We're also looking at data in the U.S. a little bit later on that will give markets a little bit of impetus. Kaylee, yesterday we already, again, saw record highs.
Record highs seem to be the new name of the game, Francine. We are awaiting that data, PPI in retail sales at 8:30 a.m. Eastern time, and of course, the all-important Fed decision tomorrow. Where that left us in the Asian session was a bit mixed. We did have stocks opening up from holidays yesterday, including in China, where actually we fell by about 1%. The Nikkei, though, was a bit higher. What was really going on in China is liquidity concerns. The PBOC deciding to roll over medium-term loans that were due to mature today. That not adding cash back into the system, thus you're a bit concerned about liquidity at this point. Another story to follow in China is actually the demand for copper. If you look at the Yangshan copper premium, which essentially gauges China's demand for imports, it's fell to the lowest since 2017. That is dragging on some of the industrial metals today. I also wanted to point out the Australian dollar, the big underperformer in the G10 space, weaker against the US dollar by about 0.3% on dovish minutes from the RBA. As for what the picture looks like here in the U.S., as Francine mentioned, we did close at record highs yesterday, and we look set for more records again this morning, at least judging from the futures market, with S&P 500 futures up about 7 points. In the Treasury market, we did see a pretty sizable move upward in yields yesterday. Today, though, we're climbing back down by just about a basis point. We're sitting at 1.48% ahead of that economic data today and Fed decision tomorrow. I also was talking about some of the industrial metals being dragged down by concerns over China demand. That includes copper, of course, which is down now. Futures down now by the better part of 4%. And finally, just noting Bitcoin, we're hanging now back down below the $40,000 level, Matt. But of course, we continue to get commentary from a number of players, and I wonder how that is factoring into the fluctuations that we're seeing.
Yeah, commentary from key players, and also technical analysts are now looking for 50,000. So under 40, we're looking for 50. When we were over 30, we're looking for 20. I want to take a look at what's going on in Europe right now, Kaylee. We have a bit of a mixed trade. You can see here, Spain is down, Germany is up. So there are, if you look at the S&P, if you take a look at the broader equity index, there's not a lot of movement, but there is a lot if you look into the individual country benchmarks. So take a look at the DAX. It's the biggest gainer of the European equity index, is up 2/3 of 1%. If you take a look at the IBEX, which is down 0.4%, you see the dispersion there. It's the biggest loser among European equity indexes. German bonds are coming, well, bonds are up in price, down in yield, and this is obviously the important thing to watch because it's really a gauge of what investors expect from the ECB. I noticed yesterday Villeroy said they're going to keep on with the stimulus, and they'll keep it on at least as long as the Fed does in terms of support for the economy. He also said that the stability of the euro, the value of the euro, is the main job for the ECB. Finally, take a look at Airbus. We're going to be talking a lot about this today. The Boeing Airbus back and forth in terms of trade, the trade war seems to be coming to an end. So, Francine, we'll see how that finishes off, and many other tariffs may also drop away at this U.S.-EU summit.
Yeah, there's quite a lot going on, Matt, and I know you drew my attention actually to a wonderful story that's one of our most top right on the Bloomberg terminal about Deutsche Bank. Now, we often hear about traders going rogue or, you know, big whales losing money, and this one is a story about Deutsche Bank making $1 billion because of a trade on freight. I mean, it's fascinating.
And a kid. He's a kid. You see the trader's like only 35 years old, and he's made $1 billion trade for, I guess these big ideas have to come from the kids, don't they?
I mean, well, I wouldn't write anyone off. I don't know if it's an age thing or it's just a brilliance thing. We'll have a discussion about it throughout the program. Now, look at what's ahead today. Bank of England Governor Andrew Bailey speaks at the Citi UK Annual Conference at 8:30 a.m. New York time. We'll get U.S. industrial production, PPI, and retail sales for May. That's what Kayleigh was talking about. UK Prime Minister Boris Johnson also holding a bilateral meeting with the Australian Prime Minister Scott Morrison. Finally, they agreed on a trade deal. And then the EU-US summit is actually being held in Brussels. Now, President Biden also wrapping up his first NATO meeting with a range of geopolitical tensions on the allies' agenda from China to Russia. The Belgian Prime Minister Alexandre De Croo spoke exclusively to our Maria today on the sidelines of the summit about resetting transatlantic ties.
We will not be divided. And that, I think, happened too many times over the last months, was that the United States and Europe were basically split apart. Right. That, I think, is not going to happen that easily anymore.
Well, Maria Tadeo joins us now from Brussels with the very latest. Maria, very positive noise there from the Belgian PM. So is the NATO alliance now reinvigorated?
Well, Francine, they will tell you it has been, and that was really the message that we heard from pretty much every delegation yesterday, in which they insisted we're now working together. This is a very strong bond. We're all committed to the alliance. When you spoke to the U.S. delegation and what we did yesterday, they also said the same thing. For us, this is a sacred obligation. We're aware that the United States does have this obligation, in particular with some of the Eastern European countries who yesterday expressed their concerns when it comes to Russia. We have seen the Russian military being deployed very close to the eastern border, especially to the Ukrainian border with China, very much aligned on that front. You know, they said this could be problematic and it could be also a military threat in the future. The one area, however, where we did see some differences of opinion was how to deal with China. You know, President Biden, of course, taking a much more aggressive tone on that. Angela Merkel, however, said we don't want to be against a country. We want to be able to bring something to the table to counter that, but we should not just be against something. We need to be for something.
Yeah, the communique released after the meeting mentioned China 10 times. In 2019, it was only mentioned once. Of course, attention now is turning to the EU-US summit today. Maria, what's going to be on the agenda?
Well, look, this is a working lunch. We understand it's just going to be a 2-hour meeting, and then after that, President Biden is going to head to Geneva. What is interesting, though, is that ahead of this summit, the head of the European Commission, Ursula von der Leyen, he will be meeting with her, just did a press conference, and she said, and this line is very striking on China, that Europe wants to diversify imports away from producers in China. We want to care about sustainability, less environment damage, more transparency on labor conditions. You know, this is the European Commission taking a much tougher tone on China when it comes to commercial relations and perhaps aligning itself closer to the U.S. position on that front. I have to say, this is the toughest language I've ever heard from Ursula von der Leyen on the commercial relationship with China.
What's the story with Boeing and Airbus? So they've reached a deal in an attempt to end the trade dispute. It looks like they're going to extend aircraft tariff suspensions by 5 years. So it's not completely ended, but they're trying to do something about it.
Yeah, look, it's not completely ended, and to some extent, Matt, it really makes sense that this is happening today, this 5-year truce for 5 years. There will be a limitation into the amount of state aid that could go into those two companies. We know that to the extent that there are still tensions emerging as to whether or not this leads to unfair competition is still very much on the table. But today, of course, they want to leave on good terms. They want to be able to announce something, and this is what they're doing, you know, to say we're going to remove those tariffs from European products, from American products, and agree to a 5-year truce. Now, the problem is not going away, but it does signal that there is a declaration of intentions here that during the Biden administration, there won't be tariffs kicking into European products, and that is something that I'm sure the EU will welcome.
Maria, thanks so much. Bloomberg's Maria Tadeo there reporting from Brussels. Meanwhile, the UK Prime Minister Boris Johnson is pushing back his plan to lift coronavirus restrictions by 4 weeks as a more infectious variant continues to rapidly spread. Well, joining us now, Sam Fazeli, your senior pharmaceuticals analyst for Bloomberg Intelligence. Sam, why do we have such a large presence of this Delta variant and it's not so present in the US or in Europe? Is it a vaccination problem?
No, well, perhaps a little bit, but I think, Francine, one of the issues that we're dealing with is that there has been obviously there's a very large community, Indian community in the UK, which continued, therefore, to travel, and many asymptomatic people or mildly symptomatic people came into the UK with that variant. I think that's what's been seeding in here, but there's definitely signs that there are seeds of this Delta variant everywhere. Perhaps I've seen numbers that keep changing. Spain a bit higher, certainly in the United States getting up to 10% potentially. So they have to watch out.
Sam, I thought Aduhelm was not a good name. Not a great name, at least. The marketing team could have done better. Meanwhile, AstraZeneca has a treatment called Storm Chaser, and that is an awesome name. But what's the deal? Did it miss its goals in a trial?
Yeah, it's the first time they were trying it in a proper setup. It's an antibody that is aimed at, and I don't think it's finished yet, preventing infection if you've been in contact with somebody and you've had a vaccine. So although it missed the endpoint of the trial and the Regeneron antibody, for instance, cocktail worked very well, there were telltale signs in the data when you look into it that actually if you give it long enough before, i.e. gives you a good protection, it could go up to 92% prevention.
All right, thank you so much to Sam Fazeli of Bloomberg Intelligence. Now I want to take a quick check on some stocks moving in free market trading here in the U.S. One of the big ones to the upside is actually a small cap company, Torchlight Energy, higher by 34% in early hours after declaring a special dividend. I would note as of yesterday's close, this stock up 411% year to date. Another stock moving to the upside is Novavax. It released pretty positive data from a study combining an influenza vaccine and a COVID-19 vaccine. It suggests that dual immunization actually may be a good strategy. That stock up about 2.6%. To the downside, though, one of the latest Reddit stocks, Petco, was mentioned on the Wall Street Bets forum. It rallied 18% yesterday. Today, though, giving back some of that gain, shares down the better part of 4% before the bell, Francine.
Kaylee, we'll talk, of course, about the variants and what it means for the recovery with Trevor Greetham. He's up next. He's from Royal London, where he's asset management, head of multi-asset. And then a little bit later, Lori Heinl, State Street Global Advisors, Global Chief Investment Officer. We'll ask her maybe some of the Reddit names that Kaylee were also talking about. This is Bloomberg.
in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Crypto is a nuanced issue, and it's possible the U.S. gets crypto wrong.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kayleigh Lyons in New York and Francine Lacroix in London. Now, inflation has been the story for months, and the data points have been coming in hot for the past few weeks. But a couple of commodities have started to turn over. Bloomberg News has written a story about it. Corn to copper, lumber futures have absolutely crashed. And they also point out housing is one of those indicators that has turned over. That's what I'm looking at in my chart today. And for our listeners on London DAB digital radio, I'll walk you through this chart. Basically, consumers' plans to buy homes have jumped during the pandemic. We all know that. Everybody wants a better kitchen from which to work. But now they have dropped in the most recent survey. And some people are saying this is maybe a sign that the inflation in housing may be coming to an end. I think it could be that consumers are discouraged by the inflation they've seen in prices and a lack of inventory. Let's turn to Trevor Gratham to talk about this. He's head of multi-asset at Royal London Asset Management. And Trevor, you know, the reason I thought about this when we brought you on is that you are overweight commodities still, and you see inflation as a legitimate threat at this point.
Yes, I mean, it's we're overweight commodities in our multi-asset funds. We're underweight government bonds. We're pretty neutral equities. What we like about commodities is there's a big service sector-led recovery that we're expecting to see over the next 2 or 3 quarters in the developed world. Been pushed back a little bit in the UK, but it's pretty clear you are going to see service sectors get back closer to normal. And that really is going to drive a lot of extra travel spending, which is obviously energy commodities. And we're also going to see a lot of capital spending, particularly on the green agenda, which boosts things like copper and a whole load of the industrial metals. And I'm not surprised to see lumber weakening because mortgage rates are starting to edge higher in the US, and housing is a very long lead indicator. It responded very quickly to looser monetary policy. I'm not surprised to see housing start to roll over at the moment. But I think there's a big, tremendous, Northern Hemisphere economic recovery yet to come. And while China is starting to tighten, it's not tightening with any kind of real feeling. So I think commodity prices have got quite a bit more to go. And therefore, inflation pressures, I think, will continue to build.
But Trevor, I mean, they'll continue to build to a point where it becomes uncomfortable with the Fed because the market seems to have repriced some of that expectations of tapering too quickly. So they seem to now believe the Fed that it's transitory.
Yeah. So I think it's possible that the bond market's got a bit ahead of themselves in terms of timing and positioning. We thought that the bond yields would rise coming into this period because we could see the very big year-on-year base effect that was going to boost the published inflation numbers, and we thought that would get people more worried about inflation. I think what the market's now doing is it's saying, well, those year-on-year comparisons are going to get slightly easier in the sense that inflation rates will probably come down over the next 2 or 3 months. And that will play into the Fed's narrative that this is transitory. But if you look at policy, you've still got a Fed that isn't talking about tapering. You've still got a government that's just spent $1.9 trillion US dollars and has got another couple of trillion coming down the pipe, which ultimately will be tax financed, but I think they'll be front loaded. And you've got the service sector recovery I've already mentioned. So I think this could be a monumental policy mistake, looking back at it later, like the 1970s, where you have massively loose fiscal and monetary policy when the economy is going to recover if you do nothing to it at the moment.
So do you think we are potentially set up for a hawkish surprise from the Fed this week? And what reaction would you expect from the bond market? Because you say you're underweight government bonds, which has been a little bit of a pain trade recently. How mispriced are they, especially if that's coming on Wednesday?
I don't think the Fed will choose now to reset expectations massively. I think over the summer it's quite possible that yields will drift. But I think as the year progresses, it's going to be harder and harder to avoid talking about some form of tightening. And so I wouldn't be surprised to see the 10-year Treasury trading towards 2% later in the summer. But at the moment, I'm not expecting the Fed really to do very much to move the bond yield. They want the market to think it's transitory, partly because they want to really keep policy loose. And I can understand, when I say it's a mistake, I can understand why policymakers don't want to take risks with COVID. You know, what we're seeing in the UK, I think we will see elsewhere. We will export the Delta variant to Europe and the US. And so this is a very bumpy situation. And policymakers don't want to be tightening too soon. But I do think it means that later in the year, you're going to, again, get people worried about tightening. And it's a very kind of two-way pull for stock markets, because when you've got the bond yield dropping and earnings numbers are still coming in strong, stock markets can make new highs and the tech sector can rally. But when you get that concern about tightening and bond yields go up, you'll get the stock market coming down again with the tech sector selling off. So I think you'll see a lot of two-way noise over the summer.
Trevor, thanks so much. Too short time, so we'll have to get you back on really soon. Trevor Greetham, their head of multi-asset at Royal London Asset Management. Now, tomorrow, stay with Bloomberg for our special coverage of the Fed decision and news conference. It all starts at 1:30 p.m. in New York, 6:30 p.m. in London, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And Deutsche Bank is set to take in $1 billion on a trader's shipping bet. London trader Mark Spine made a long shot bet on the once distressed Israeli company Zim Integrated Shipping Services. That's put Deutsche Bank on track for one of its biggest wins since its trades against U.S. subprime securities more than a decade ago. And Jamie Dimon warns that Wall Street's pandemic-era trading boom may be coming to an end. JP Morgan's CEO signaled that his bank could see a 38% drop in trading revenue from a year ago. That's a bigger drop than previously expected. Meanwhile, Dimon says it could be one of the best quarters ever for mergers and acquisitions revenue. And Matt, of course, we knew that the volatility couldn't last forever. Banks were going to have to look elsewhere to keep raking in the kind of money they have been over the last year or so. And maybe M&A is where it's going to be at.
Yeah, for sure. M&A is very strong. Jamie Dimon was very positive on M&A. And of course, we knew last year that trading this year wouldn't be at those levels. They were off the hook. So the problem is they're coming in a little bit under Wall Street forecasts.
Yeah, to be expected. I mean, within the range, but you're right, it was a little bit below expectations. And then we also have this great Deutsche Bank story. And then the other one is, of course, the working from home. I also referred to Matt's great chart yesterday that said, despite the rally we had in EU banks, they're still undervalued. I don't know whether taxation comes in and whether that means that things could change the fortunes of EU banks. Coming up next, we may talk banks with Lori Heinel, State Street Global Advisors Global Chief Investment Officer. She's up next, and this is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, quite a lot going on. We are expecting some data over in the U.S., Matt. That will give us maybe an indication of what we're looking at for the markets. And we had that liquidity concern in China, and of course, we're on the back of the NATO. We have now, some possible agreement between the U.S. and the EU, and then tomorrow we look at Biden and Putin.
And the Fed. It's all about the Fed, right? I mean, that's really the main event this week. So I look at the 10-year yield dropping down to below 150. It briefly made it back up again a little bit yesterday, but then ducked its head back down again. If the Fed is at all hawkish tomorrow, we are gonna go to the races. And, it may be just a change on the dot plot, all it takes. So it'll be really interesting to watch rates around tomorrow's meeting.
Yeah, and that will, of course, move the markets. Yesterday, we were at record highs, Kaylee.
Record highs again this morning, Francine. Actually, in Europe, the Stock 600 today is set for its 8th consecutive record high. The thing about it, though, is actually over the last 8 days, as it's reached record after record, it's only up about 1.6% over that time. Again, we are looking at relatively small gains today, even if we do climb to an all-time high, only up about 0.4%. Here in the U.S., we also closed at records yesterday. Look set for more of them today if you're looking at the futures market. S&P 500 futures up about 5.5 points right now. Matt, you were just talking about the bond market, hitting that 150 threshold again yesterday, but we are back below it this morning at 148 ahead of this morning's economic data and tomorrow's Fed decision. And then we've also been talking about the cooling down in the rally of some of the industrial metals. Copper futures lower by 3.8%. That, in turn, is weighing some stocks tied to metals and mining, weighing on some stocks tied to metals and mining in pre-market trading. One of them being Freeport-McMoRan. It's down by about 2%. You have Cleveland-Cliffs down as well. And then some other stocks I wanted to check on have to do with the meme stock Reddit phenomenon. Petco, which trades under the ticker WOOF, rose 18% yesterday after getting mentioned on Wall Street Bets. WOOF, Matt, is the best ticker ever, down about 3.6%, and AMC is lower by about 2.25% as well.
I like it. I like it. It used to be if you pulled up Harley-Davidson, HOG, equity on the terminal, it said oink right in the top. I think some programmer
and Pat says
put
meow.
That in there. There you go. I love those things, and now they're gone. You know what, though? There have been some really positive developments in the present. One of those is the savings rate, I guess. That seems like a good thing, right? And it's been across a transcontinental issue. Take a look at this chart for our viewers on radio. I'll just tell you that, we didn't save too much. Americans here represented in white, the UK represented in blue. We're saving less than 10%, and Europeans not very much more than 10% over the past few years. But of course, the pandemic hit and there was not much to spend your money on. As a result, the savings rate absolutely soared in, this is the US, the UK, and Germany. Now, it's come down a little bit here, but it's still at 14% for U.S. savings, 15 almost. That's a pretty incredible savings rate, and this is part of what Folkerts, Landau, and Hooper expect to drive growth and possibly also inflation to unsustainable levels, Francine. So this is something I think that we all need to watch. I guess it depends how broad it is and how much of it really is in cash that you can just put out there. But it could drive the economy and inflation over the coming months and years.
I love that chart, Matt. Now, discussing this and her mid-year global outlook is Laurie Heinel, Global Chief Investment Officer at State Street Global Advisors. Laurie, as always, thank you so much for joining us. Now, the broad market views that you've put out there and positioning is basically your overweight equities and overweight spread, underweight bonds, and you want to diversify some of the growth asset exposure. What looks frothy right now?
Well, a lot of parts of the market look a little bit overdone, and part of the reason that we've been diversifying our equity exposure is that we think that the U.S. is doing well and it'll continue to do well, but there are other parts of the world that are starting to look more attractive. So Europe, for example, much more attractive from a valuation perspective and a little earlier on in its economic recovery. So we have started to look at Europe as a theme.
So where do you see the most value in Europe? If you look at some of the disbursement of the tranche, which, we talk about every couple of weeks, but if you look at, the chip shortage, is there a specific way to take advantage of what's going on in Europe over the summer?
Well, Europe generically is a bit more value-oriented than the U.S. indices, so much less weighting to technology, for example. But you do have some healthy growth areas. You've got pharmaceuticals, certainly you've got some retail, you've got some financials. So it's really both a valuation perspective from a broad region standpoint, but also that kind of rotation to value, which should do better as we get a little longer in the recovery.
At some point, there's going to be a hawkish turn, right, Laurie? I mean, at some point. Yesterday, Villeroy said that the ECB is going to keep stimulating the economy, keep supporting this economy, at least as long as the Fed. Who do you think blinks first?
Look, it's a little too early to tell. Right now, none of the central bankers are really interested in blinking. It's easy to think that we're getting ahead of ourselves here in terms of recovery, but we still have a lot of vulnerability. We're seeing new variants, for example. The UK, for example, just delayed its full reopening again. So there are lots of reasons to be still a bit more cautious, and we think that central bankers are actually being quite smart about not being too aggressive at choking off this recovery, because it is still very early days.
So we have been getting a lot of warnings, though, lately from Deutsche Bank that I mentioned earlier, from Andy Haldane, and from a lot of other very brilliant minds that say this is a really dangerous moment for central banks. Do you disagree?
It is a dangerous moment, and part of that is how the market reacts to what they say and what they do. So we do think that the communication and the messaging of any change in policy is going to be quite delicate. So certainly when we read the minutes tomorrow or hear the statements tomorrow, one of the things that everybody's going to be hanging on is every word of the central bank. Are they saying anything that suggests that they're going to accelerate the reduction in asset purchases or pull forward some of their rate increase expectations? So that's going to be the delicacy here, is not sort of how the central banks continue to do what they're doing, but how they communicate what they might do in the future and when.
Well, and of course, we have a lot of conversation about timing, when normalization will start. But how long is normalization going to take?
Yeah, look, it could take a very elongated period because, as you note, we're at rock bottom levels. It's this idea that somehow getting back to 1% or 2% is going to be devastating. Eventually, we'll probably get back to something far north of that, but there's a long, long runway to get there. And again, one of the most important things is going to be, does the Fed and as well as other central bankers continue to monitor the current environment? How do they communicate to markets about what they're intending to do, and how do they delicately balance that pivot to eventually pulling back a little bit of the stimulus?
And as we look forward to normalization, as we see inflation coming in pretty hot, we have equities hanging out around record highs and a 10-year yield at 1.48%. Is this just complacency?
Well, certainly there's fear of complacency here, but there are also fundamentals that are driving this. Again, we're going to have really strong growth this year as well as into 2022, we believe, and that's going to propel earnings growth for companies. Keep in mind that a little bit of inflation is actually quite positive for equities in general. It gives them a bit of pricing power, and so that will be one of the ballasts that will continue to propel this market higher still. So it's a little bit of complacency, but it's also fundamentals.
Lori, when you look at some of the things that we talk day in, day out, which is cryptocurrencies, is there a point where I know it's not something that you want to get involved with at the moment, but what could change your mind? Is there something that could evolve into something that asset managers just can't ignore?
Well, one of the big things is going to be how does this space get regulated and how does it get more integrated into the regular economy and the regular monetary transmission mechanism. So things where central banks, for example, start to become more supportive would be positives. The idea of blockchain is clearly a technology that many are embracing and has a lot of promise. And so the role that cryptos might play in blockchain would be important as well. But keep in mind that there are literally thousands of different cryptocurrencies. And so which ones are one-or-ones are going to ultimately benefit from that is a little difficult to discern just yet.
Lori, thanks so much. Lori Heinel there, Global Chief Investment Officer at State Street Global Advisors, also with her new calls out for the rest of the year. Now, coming up, we'll talk about NATO, we'll talk about Biden in Europe with Guntram Wolff. He's Bruegel Director. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Wednesday, the Fed decides. Will the Fed react to accelerating inflation concerns? Are members eyeing an earlier rate increase? Coverage begins at 1:30 p.m. on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, President Biden continues his trip in Europe today with an EU summit. The key issues from relations with China to action on climate change are on the agenda, and we're joined now by an expert in geopolitics and the European Union. He's Guntram Wolff, director of the Bruegel think tank. He's also held positions at the IMF, the G20, and the European Commission, which makes you the perfect person to talk about this week. Given what we've already seen at the G7 summit and the NATO summit yesterday, how productive do you think this U.S.-EU summit will be today?
Well, look, I think the first point is really that everybody is so relieved to be able to talk to each other frankly and openly again. I think it's been such a relief to have a sort of pro-European U.S. president back in Europe and really be able to see eye on many of the issues. Now, I would say what we've learned is also that sort of on the headline, that it's relatively easy to agree, but I think on the details, it's much more difficult to agree. And I think the big challenge that these leaders today will face is really on the trade side to come up with something very concrete, but also on the vaccination story. I think the G7 meeting was not yet fully satisfactory, and I would hope that they would agree on something in addition to what has been agreed.
So, Guntram, what does the U.S. need from Europe, and what does Europe need from the U.S.? Is this, an alliance that actually is necessary just to deal with China and Russia, and together are they strong enough to change the world order?
Well, I mean, I think the natural tendency for Europe is, of course, to be very aligned with the United States, and we feel much more closer than to the US than to China. But I think already in the G7 communiqué and afterwards in the communication around it, you could see that while President Biden takes a very tough stance on China, the Europeans are much more nuanced. And I think they are much more nuanced for a reason, because, basically it is in the EU's interest to have commercial ties with both the US and with China. And it's very difficult for the EU to just give up on the China relation. So yes, I mean, of course, on some matters, such as human rights, but also the way the Chinese state system, state economy operates, we are extremely well aligned with the US. But I think the approach, how to tackle the China issue, will be different and will remain different. But I think it's clear there is more collaboration with this president than with the previous one in China.
But Guntram, so how should Europe actually speak to China? Europe is also losing Angela Merkel. Brexit happened, so the UK is not really in that club anymore. How difficult is it going to be to keep these economic relations whilst keeping on check on human rights, but also some of the economic policies coming out of China?
Well, I mean, my impression is that there will be quite some shifts in the way the EU talks with China. I mean, at the moment, it's still very much driven by Mrs. Merkel, the German Chancellor, who has taken a very, if I can say so, pragmatic approach. So basically one where the emphasis is on basically the economic relation. It's pragmatic in the sense that it says, well, China exists, we have to deal with China. And I think the new German administration could well take a tougher stance, meaning one that puts values such as human rights more upfront and will be more confrontational. And the question is, will a more confrontational approach deliver anything? And, I frankly speaking, I have my doubts, because President Trump has been extremely confrontational. And in the end, what did he achieve? He didn't get anything from China. So I think we need to work with China. We have to set red lines. Of course, we have to defend our interests domestically, but we also have to recognize that we have to work with China. I mean, China is just one of the biggest powers in the world, and it's an economic superpower and a military superpower. So we have to work with China as well as with the US, but we have to call out mistakes.
But not with Russia, right? I mean, especially as President Putin is annexing Crimea and Russia is having people killed in foreign countries and holding Alexei Navalny prisoner. And yet Berlin wants to make a huge trade deal with Russia in terms of the Nord Stream 2 pipeline. Why does NATO allow that?
Yeah, I mean, look, I think there I'm very much on the side of the US. I mean, I think we have been too much in the business of appeasing Russia, doing deals with Russia instead of showing a clear confrontational line. I mean, the EU has been able to impose sanctions on Russia for quite some time now, following the occupation of Crimea and the annexation of Crimea. But I think what is needed is a more confrontational approach. I mean, this is quite a problematic regime with Navalny and many other human rights abuses, and the EU needs to show a tough line. And it can show a tough line because economically we are not dependent on Russia. I mean, there's a bit of gas dependency, and the aim should be to reduce that gas dependency vis-a-vis Russia, not to increase it. And in that sense, Nord Stream 2, I think, goes in the wrong direction.
Guntram, thanks so much for all of your insight. Guntram Wolf there, director at Bruegel. Now, a little bit later on Bloomberg Surveillance, we'll continue discussing the EU-US summit with the US Commerce Secretary, Gina Raimondo. That's at 8:30 a.m. in New York, 1:30 p.m. in London, and this is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think crypto is the next internet-sized opportunity for the United States. I think it has the potential to create as many, if not more, jobs in the internet, similar with economic growth. I think it has the potential to square the circle on the privacy internet issues that we've been talking about with big tech companies for the last 10 years.
Fred Ersham there, Coinbase and Paradigm co-founder, discussing crypto's potential on the latest episode of Bloomberg Studio 1.0 with Emily Chang. You can watch the full episode of that this Wednesday at 9:30 p.m. Eastern Time. And on Thursday, also across our other regions, I'm guessing you can find it online as well. There's so many ways to access Bloomberg television content. Now, 99% of cryptocurrencies are overpriced. That, according to Digital Currency Group CEO Barry Silbert, in a tweet conversation with Joe Weisenthal. Joe is the host of What'd You Miss, of course. He joins us now to discuss. I thought this was, truly fascinating, Joe, because you'd expect Silbert to be a cheerleader.
Yeah.
Or at the very least, massage a little optimism into the story of cryptos, and yet he told you 99% are overvalued.
Well, I think there's two things. One is that, I think if you talk to most people in this space, they will agree. Even the ardent bulls will admit there is a lot of junk in the space. And, if you go to like a site like CoinMarketCap, as I noted in a piece, there's like 10,000 coins. Like on TV, maybe we talk about like 2 or 3 sometimes, but there's thousands and thousands. Also look, the people in this space tend to have investments in some of the big ones that everyone knows and talks about, like Bitcoin and Ethereum, and they would probably like new people who enter the space to not just go find some cheap nominal coin that, looks like it's inexpensive and buy their bags to some extent. So, you can denigrate lots of crypto while also theoretically benefiting the investments that you have.
I really just want to know what's in the 1% that isn't overpriced that he thinks. But when we say 99% of an entire asset class is overpriced, what does that mean about the use case or the investment thesis?
It's a really good question, and it's a way that cryptocurrencies, to the extent that there is a use case that exists, and of course people debate this nonstop, this space is like riven with junk, and everybody knows it. And there are coins that have no purposes, and there are coins that are jokes, and there are coins that are almost blatant Ponzi schemes and pump and dump schemes where everybody who's in on it knows, and the only goal is to get in before other people do. And so it's not like, other asset classes, commodities, even small ones have niche use cases. Stocks, many of the small ones have some sort of measure of cash flow or something. That's just not the case with many of the coins.
So, Joe, does it mean, and good morning from London, does it mean that there's only going to be one coin, right, and that'll probably be green, that will end up surviving and being the king of coins?
To rule them all.
The biggest coin believers, and some of them absolutely believe that, so of course, Bitcoin maximalists are convinced that in the end there will be one coin, it'll be Bitcoin, everything will be built on Bitcoin, everything else they say is a scam or not sufficiently decentralized or something like that. A lot of the people who are into Ethereum are also into Bitcoin, but they're also Ethereum maximalists who essentially believe that that will be the base transaction layer, and that'll be the sort of base layer for everything, and that you can build all sorts of decentralized apps on it and so forth. And then there are people who believe in some sort of multi-coin future in which, there are multiple different chains for niche purposes, maybe one for decentralized finance, another one for NFTs, another one for savings, so forth. Look, the space is so young that no one, I think, you can't trust anyone too much on what the future looks like.
Joe, thank you so much. I love the word maximalist, crypto maximalist. Joe Weisenthal there, co-host of What Do You Miss, and also overall guru on Twitter. Now, coming up in the next hour, Brian Weinstein. He's Morgan Stanley Investment Management Head of Global Fixed Income. We look at the Fed tomorrow, we look at markets, we look at U.S. data today, and of course, Biden on his European tour. This is Bloomberg.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
We are in a boom. There are some supply side dislocations that are a bit confusing, but I think growth is going to be quite strong.
Low inflation, low rates, positive economic growth, and strong earnings. That's a pretty good backdrop for risk taking.
The Fed has successfully lulled everybody to sleep with the Kool-Aid that they are never really going to focus on inflation.
I think in the June meeting, I think if they say anything hawkish, it'll be a mistake.
The question is, what risks are most important to the Fed and what risks are most important to the world economy?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. We welcome you. If it's Tuesday, it must be Belgium. That's where the president is today. International relations as he travels to Geneva.